Welcome to the Hedged Edge by RCM Ag Services, where we're getting out of the field and onto the mic to bring you weekly market updates, commentary from commodity experts, and monthly interviews with the biggest names in agribusiness. Welcome to the old and new crop risk management strategies in 2023 Agriculture Market Outlook webinar. I'm your host, Jeff Eisenberg. I'm the Managing Director for RCM Ag Services and host of the RCM podcast, The Hedged Edge. Be sure to follow us on YouTube and Twitter. I'll put the links inside the chat here in a little bit. So today, really, as we start 2023, the stakes couldn't be higher in the agriculture sector. The world population is growing at a rapid pace. We've crossed 8 billion as of last November in terms of population across the world. There are lower stocks of our major grain supplies globally due to the historic drought and continued war. Energy and interest rates have accelerated rapidly versus this time last year, leading to higher input costs and raising the break-even levels for both farmers and end users to unprecedented levels. Oh yeah, just like I just said, there's still a war going on, so we got to remember that too. Anyway, to help give us some insight and answers to what lies ahead, we're lucky to have two highly respected panelists with us today from both the banking side community and the risk management side of the business. Welcome, Rebecca and Jody.
Thank you.
Thank you, Jeff.
Yes, great. Well, it's nice to be talking with you both today. I know it's snowy here. We got a snow day for the kids in Ohio. It's been a wild year. What we'd like to do here today is we'll do kind of a brief intro and bio for both of you, and then jump into some questions for Rebecca. And then Jody's got a nice presentation for us on the status of the world when it comes to agriculture. So throughout the time, I encourage anyone who's listening to type questions inside the chat. You can send those messages. We'll either address them in real time as they come through, or perhaps at the end. So the more questions, of course, the better. Everybody likes questions. And so without further ado, let me introduce our two panelists. First of all, we have Rebecca King. She is the Senior Vice President of Old National Agriculture Group. She has over 25 years of banking experience and takes the time to gain an understanding of her clients' needs, and then works to tailor those needs into a plan to fit each individual operation. Rebecca oversees the Ag Banking Relationship Team. The Ag portfolio of Old National is geographically diverse across the upper Midwest. So again, welcome, Rebecca.
Thank you so much, Jeff.
Absolutely. And Jody Lawrence. Jody is the head of research for RCM Ag Services. Jody began his career as an accountant after receiving a degree from Memphis State University in 1989. You got to take that year off your bio, Jody. Makes you sound old.
I think the beard takes care of that. Nobody really cared. They care that I graduated, but the beard kind of gives it away that I am not a Gen Xer.
Fair enough. Shortly after, Jody started working with farmers on business and marketing plans, which ultimately led to the founding of Strategic Trading Advisors in 1999, a consulting brokerage firm with a well-followed daily newsletter. Jody's research on ag markets now attracts more than 7,000 farmers across 33 states, opening up a tremendous network of ag specialists across the grain and meat complex, for which Jody to draw upon in assisting select clients in structuring agriculture hedging via futures and options markets. So again, welcome, Jody. Appreciate you taking the time while you're on the road.
Thank you, Jeff. Good to be here. Rebecca, good to see you again.
You too, Jody.
So let's start here. Again, the world is volatile. There's a lot going. Like a little bit of Q&A here with Rebecca. We'll start on the banking side.
Sure.
Yeah. So Rebecca. Oh, don't let me forget this part. We do need to move forward with our disclaimer and reminder all that there are risks. So with that, we'll skip over to Old National. Rebecca, Old National, really, you were working with First Midwest and then was acquired by Old National last year. You've had an excellent transition. You've got an awesome team. that we've had a chance to meet with ourselves, and it's growing. So before we kind of get into what's happening in markets, could you just give us an update on the transition and the good things about Old National?
Sure, absolutely. Thank you. So First Midwest and Old National completed their merger in July of 2022. We brought together agriculture professionals from each bank to form one team, which is I call the ag vertical. We have about 25 members that are completely dedicated to agriculture on the sales, the credit, and the customer support side. All of these individuals have farm backgrounds, either directly continuing to farm with their families or having been raised on a farm. Myself, I farm with my husband in West Central Illinois. So all of these personal experiences really help us to bring to the table an understanding of your business and how things are going for you, because we're experiencing the same things. One of the great things about our merger is that we've really expanded our footprint. So Jeff has that on a slide here. I don't know if it's possible to make that any bigger or not, Jeff, but you can see where the blue dots are. Those are locations, Old National locations. Not all of them are ag locations, but that is where our primary business is located, as we said earlier, in the upper Midwest. So our dedicated ag bankers are in more of our rural locations. We also have in 2022 added an agribusiness piece. We previously were very heavily centered in production agriculture, but we have added agribusiness by hiring an agribusiness expert who's actually working out of our St. Louis office. And he is touring around the footprint, meeting agribusiness prospects and also speaking with other financial institutions with regards to working with them on some of their larger agribusiness clients. So we feel very fortunate to be part of such a large organization and have the reach that we do. And our merger is behind us now, so it's all forward looking for 2023. And I would, any other questions you have with regards to the bank, I'm happy to answer.
Perfect. That's super helpful. And I guess when we were meeting in December, you also adding an office in the Ohio as well, Cleveland area.
Yeah, in the Cleveland area, those are primarily healthcare specialists in the Cleveland area, but we definitely can talk to customers in the Ohio region as that is considered, part of Old National Bank's footprint.
Perfect. Sounds like good opportunity to grow, especially matching both the farmer and the commercial side. There seems to be some
Absolutely.
nice synergies that could develop out of that.
Absolutely.
As well. So I'm going to go ahead and stop the screen share for a minute. We'll just kind of go back and forth with each other. And Jody, of course, if you have questions here to jump in, but let's just jump into it here, Rebecca. I mean, people that are listening, we've talked here at the beginning. Interest rates are way different than they were a year ago. And since you're in banking, I know it's not the most fun thing to talk about, but it's probably on everybody's mind. Where are we here with the interest rates? And two things. One, I can say it, and maybe your compliance doesn't want you to, but I think we're probably nearing the end of the tightening of the tightening schedule. Another 50 base, maybe a point. But so there's more risk. The major part of the risk is gone. But how is that impacting and affecting both agribusiness on the buy side, production side, et cetera, from the people you're talking to?
Sure. Well, I think this kind of summed it up. I had a meeting with a client last week and I said, what's the biggest challenge you're facing in 2023? And he said interest rates. And I think that was right on. Interest rates are twice of what they were 1 year ago when we would have been having a similar conversation. You're welcome to predict. I don't have a crystal ball, but we do know the Fed is meeting next week. We know that with certainty, and there's a very high probability that we'll see another rate increase of 25 to 50 basis points. I think we're all hopeful that the end is in sight and that 2023 will start to perhaps even see a stability towards the second half of the year in rates. So that being a very large part of a farmer's budget, it makes me want to recommend to everyone that they're really doubling down on, on their penciling of all of their expenses and really being aware of where that interest expense is affecting them. Certainly as a banker, interest rates are a high topic of conversation with each one of our customers. So we have those every time we meet with them. But taking a look at other areas of expense and making sure that your production costs are where they need to be, this is a definite threat to profitability down the road. So be forward looking, pay attention to where you are, pay attention to your marketing. Take advantage of the prices available to you when they are available to you. We can't change the interest rates, but we can sort of massage what we're doing around them until we start to see things change and hopefully some sort of relief, in 2024.
Right. Yeah. I mean, relief, the government likes to give us all money. So hopefully soon enough,
Right.
they'll want to give it to us again. In the meantime, as we'll talk here with Jody shortly, the reality is it's a new world in terms of break evens as you're talking and costs.
Mm-hmm.
And, last year was largely, hopefully widely profitable for a lot of farmers and other agribusinesses. But it's, last year's crop is financing this year's crop, and
Mm-hmm.
that cycle continues. Where are you seeing from your customers and from the bankers that you're, in your network, where are they seeing the break evens, particularly on the production side, kind of coming in for corn and beans? And, we could talk how that reflects to today's price after that.
Sure. And I mean, let me just caveat that every producer is going to have a different set of costs based on the number of acres that they're farming. So I'm not going to give you like specific numbers that this should be your cost of production. But from the analysis that we've done, we definitely see that corn input expenses have increased by at least 10% year over year. And if you go back 2 years, it's almost a 50% increase. It can be almost a 50% increase. So that's significant. For beans, beans don't have quite the big jump, I would say, but for the last year over year, maybe a 5% increase in producing your beans. And bean prices have remained very strong. And I know I'm not Jody, so I'm not going to go down that path. But I believe that when you're looking at your mix of corn to beans, you've got to take into consideration where are you going to make the most profit, for the coming year, and then make plans accordingly. So it's a significant issue. And if you don't understand where your costs are, now is definitely the time to meet with your banker and, get the help you need to be able to determine how your profitability is going to be impacted for 2023.
Yeah, that's good. And we kind of run some numbers. Jody, where are we at? Generally, $1,000 for corn, 800 for beans.
It might be a little bit lower on beans than that, but it's certainly, as Rebecca pointed out, costs have really gone up as we've emerged from the pandemic because you're in a position where nobody really understood about the manufacturing and everything that was going on, what could have happened, and the supply availability in 2020 and 21 of fertilizers. But then as prices have risen in corn and in beans because of weather markets and yield loss in the northern and southern hemispheres, the manufacturers at the highest level of those products, the CFs, the Mosaics of the world, have increased their prices because they know that they have some margin while there is, coming out of a couple really strong years on farm from a cash perspective from everybody. So cost of farming is expensive. I get asked the question all the time, when's the price of land going to stabilize? I think everybody is now just hoping for stabilization rather than actually thinking the price of land may go down. But really, the bottom line on everything is as long as the production continues to rise, in that acre, the APH is increased year after year after year. The value of that land will hold at worst very steady. And then if you get in a situation where you have very motivated buyers, we have seen some really astronomical sale prices that just don't pencil in the old way of buying farmland. But you look at farmland now, it's not the means to the end that you have to have land rented or owned to be able to farm. It's now an investment vehicle for so many others in the industry. People who have sold land and have a 1031 transfer come in and they don't want to pay any taxes, so they pay more than historically it would have brought from a production standpoint. You have neighbors bidding against each other, sometimes in a friendly competition, and sometimes in an unfriendly competition. And then in this generational transfer of the land and of the farm and of the wealth that we're seeing, you had grandparents farm, and you've got a lot of grandparents not on the farm who, when they're fortunate enough to inherit this, don't understand the economics. The people that are farming it, all they see is an income producing asset like a mutual fund or a CD or something, and they want to maximize the value of that, and they get lost in the pursuit of some dollars at the expense of the relationships from the people that have been farming it for years, decades, maybe even generations. So farming's expensive, and it starts with the land. And as the price of corn and beans, uh, the variance there and the volatility in those prices, that's what we're seeing now with high prices to start the year. We're seeing the high input prices follow.
Yeah, thank you for that, Jody. And I'm guessing it wasn't Old National that financed that $27,000 per acre purchase in Nebraska, Rebecca?
Probably not, but if it was, they had some good equity in that purchase.
Yeah. Yep. Exactly. Very good. So, Rebecca, just want to finish up with you, and we'll jump over to Jody. He made a comment, and you've commented already. The importance of risk management today is essential. And so, what are you talking to? How are you talking to your customers about that? What percentage of your customers are typically forward pricing versus those that probably should be?
I think that those who forward price are usually the customers that are farming greater number of acres, but that doesn't mean that everyone can't forward price.
Correct.
It's a cost of production, as we talked about. Some clients would prefer to segregate that cost off into a separate note, a separate loan, that they're just accounting for their costs of their marketing activities, right? That's something that we do. You can call it a hedge line of credit, or you can call it a marketing note. We can call it anything you really want to know, but it serves a purpose really to show what you're spending and are you getting the return for the activity that you're doing. So it is good to keep that separate in some cases. Some of our clients don't do as much, and they just continue that through their regular operating line of credit. But we do discuss the need to either, even if it's just working with your local elevator, doing something, having a plan, paying attention to the advice that Jody gives, and making sure that you're understanding that what's available to you today may not be available to you tomorrow. And if you do some sensitivity in your cash flow, you're going to know what your best cost, or excuse me, what your best price is going to be. And it allows you to really focus on that. This is the right time of year to be doing that. So that as you get busy in the field and other things take your attention away, if you really know what that break-even price is and where you want to be on your marketing, as things change quickly and you're not always able to be sitting in front of your computer, you have that in the back of your mind. So doing that pre-work and certainly working on that with your banker is also really important, so that they have the confidence that you know what you're looking for.
Yeah, thank you. And obviously we've had a chance to meet your team, and everyone has got a exceptional amount of experience in giving that guidance and feedback. And, obviously we're working with you guys to, share some of the the content and recommendations that are out there as well. So from our side, so that's super helpful. Rebecca, was there any other comments that or questions you had for Jody or I before we shift the show over to him and then come back at the end?
I'm happy to take any questions from the participants at the end. Jody always gives a great presentation, so looking forward to seeing what he's got for us today.
Excellent. So without further ado, I do see some questions coming in related to price and input costs, and so we'll address those, throughout and or near the end. So thank you. Continue to please ask the questions, and I'll help source them into what Jody and Rebecca and I can help answer. So Rebecca, thank you very much. Looking forward to flipping it over here to Jody. So without further ado, Jody, I'm going to share the screen. And then if you need me to move a slide, just go ahead and say slide and I'll flip it. So you should now see the screen.
Yep, I can see it. Thank you, Jeff.
Yep.
I apologize. I got a bottle of water and I may do a little bit of coughing. Winter cold, travel cold, as they always set in, but appreciate everybody logging in today to follow through with this and just kind of see what we're thinking about the markets. As you can see from the title, the changing dynamics for markets in 23, there are a variety of things that we think 2023 will see a pretty noticeable change, if not very sizable change in from 21 and 22, from a production standpoint, from a weather standpoint, pricing standpoint. You look at outside events. We already talked about the Federal Reserve and the interest rates, but just so many things that we think this is one of those very transitional years that last year's marketing plan, really the past 2 years marketing plan, where you were able to be patient or procrastinate, depending on which one of those you really want to label it. The markets kept going up because South America had a bad crop, and then the U.S. got off to a tough start in April, May, when December corn rallied for 21 straight trading days, and everybody was richly rewarded for holding on to their grain. But we're getting to a point now where that philosophy, we don't believe is solid anymore, heading for what we know and what we're seeing in 23. So I'm going to talk a lot about the changes that we see coming and hopefully how we can address those. Mike Tyson, a famous American philosopher that everybody knows, was a particular favorite of mine in high school and college, watching him box. It was a little bit like watching Tiger Woods when he was at his peak in golf, or Jack Nicklaus, and Joe Montana or Tom Brady on the football grid, or somebody like Michael Jordan playing basketball, because he clearly was the very best at what he did. And his great quote that stays with him and stays in my mind for 2023 is that everybody has a plan until they get punched in the mouth. And how that really applies to your marketing plan is, just the last week, this is a perfect example. We saw how much beans have dropped on Sunday night after the extra rain in Argentina started to fall. Corn followed, and then the volatility after that, because the rally that we saw after the January crop report, the 3 weeks ago tomorrow, those faded pretty quickly in the face of the one thing we do see changing is this transition, the El Nino La Nina transition, that should bring, and historically has brought, more more conducive weather around the world for global production. Next slide, please, Jeff. And all of these things we could spend the entire time on, but I'm going to break them down and talk deeply enough about each one where you can see where I'm standing on it. The ridiculous volatility that we're seeing is with us to stay. We'll never see it go away anymore, because we just have too many interior and exterior impacts from around the world, whether it's the Russian-Ukraine war, our poor relationship with China, China's relationship with Russia, what's going on in Brazil and Argentina, the world banking situation with rising interest rates. Is there going to be a world recession? Just so many things out there. And we haven't really talked about weather too much to this point, but it's just a situation where the volatility is going to be here. So however you set up your marketing plan, just know that we're going to see these, big spike rallies that, followed by sharp pullbacks and vice versa. And sometimes there's news, sometimes there isn't news. And a lot of the volatility now is being driven because we have billions of dollars of outside investment money in our markets, whether it's on the ground that we talked about earlier, or whether it is speculative money who trades the charts and they're just looking to diversify their portfolio with raw materials rather than Microsoft stocks and things like that. And with that, we're just going to continue to see this volatility. The big report that I mentioned briefly 3 weeks ago was the USDA's look at what they're considering the final 2022 numbers for the U.S. crop. That crop, while the USDA will not adjust the corn yield that came in at 172.3 or the acres harvested for corn or beans. They will still play around with their supply and demand balance sheets as things change, and they can notice and go back even as far to make some corrections on mistakes that they've made. And those corrections may go all the way out to June, July, or August before they make them. But for what they said as far as yield and acreage, the 172.3, while still a top 10 national yield historically, it was right at 5 bushels below trendline expectations and right at 11%. And the USDA, or excuse me, not 11%, but right at 1.5%. The USDA considers anything lower than 2 bushels away from trend to be a low crop. And with this one being 5 bushels below, it certainly kind of falls into their definition of an underachieving crop. But the crazy thing about it is you can divide the corn yield in the Corn Belt this year in between Eastern Corn Belt and Western Corn Belt with a line vertically through Des Moines, and everybody west of Des Moines had really, really tough conditions this year. A lot of huge production areas in eastern Nebraska, South Dakota, Kansas ended up getting 20-30% of their normal rainfall, and with yield losses in some cases pushing 60-70% of normal APH. So while the Western Corn Belt struggled, the Eastern Corn Belt, or everybody east of Des Moines, did exceptionally well to pull that average up just to get the yield to a 172.3. And that's a combination of things. It's wonderful stewardship of the ground from every farmer who's trying to coax all the bushels out of it that they can, improve genetics in seed, improve technology, soil mapping, all the GPS function and efficiency that you get from that technology bump and all of your equipment all across the board. It's helping us get more out of that acre than 10 years ago we probably thought we would be getting in 10 years. The 79.2 million acres harvested, that was really the bullish hook in this, because historically the USDA uses 8% as their number from what we plant. We planted just under 90 million acres, so I'll call it 90 million, and 8% of 90 million would be 7.2 or right at 7 million. So that number historically would have been closer to 81.5 to 82 million acres harvested. But because of all the abandonment in the Western Corn Belt due to the bad conditions, that number was a little bit higher. And losing 1 million acres of harvested corn has a much bigger impact on the bottom line and on the supply side of things, because that took off 172 million bushels, whereas if you just adjust the yield a half a bushel, you're talking about 40 or 50 million bushels. So that this year, and it bears out because everyone across the country has seen better basis historically than you will see at this time of year, especially through harvest, because you had such corn deficit in the Western Corn Belt with all the feedlots and cattle industries out there, and people were paying up to get it shipped out of a more corn rich area of the Eastern Corn Belt. The bean number, good, not great, at 50.2 on the yield. The harvested acres at 86.3. That number was not affected nearly as aggressively as corn. Planted about 88 million acres. So only, and this is pretty much standard for the USDA. USDA expects about 1 to 1.5 million acres of beans not to be harvested, and they were pretty much right in line with that this year. But the 50.2 yield does show that the crop ran into some headwinds, mainly from the Western Corn Belt, because the trend line to start the year last year was 52 bushels an acre. The South American crops were also updated, and the USDA does their own guidance on and expectations for Brazil and Argentina's corn and bean crops, while the governments and the private analysts in Brazil and Argentina do their own. There is still a good bit of separation between what we would consider a high USDA corn estimate for Argentina, and we'll see how that bears out, because Argentina has been stuck really for almost the past 2.5 years in a drought similar that we had last saw in the U.S. in 2012. So we know that their corn yields down, even though the rains have come. A lot of it is past the point of help. Will stabilize, so we will see how that works moving forward. You look at Brazil's corn crop. One thing I want to show you is go back up to the U.S. We produced a 13.7 billion bushel crop. Brazil and Argentina produced just right at 7 billion bushels. So under normal circumstances, South America will produce about half of what the U.S. normally does. So keep that in mind, because that's why the world needs U.S. planting corn far more than they need us planting beans. And the bean reason is highlighted by how many beans are grown in Brazil and Argentina. Just in Brazil, at a 5.65 billion bushel bean crop, they outproduce the U.S. by 1.4, about right at 30% larger. And the U.S. will never catch up to Brazil, because Brazil has it's seemingly unending amount of available acres that they can bring into production, whether they go into the highly productive areas by taking down the rainforest or adding new agricultural standards to some previously less than productive ground. They've got a lot more ground to expand on than the U.S. or Argentina. Argentina is pretty much capped out with where they are. They may have 1 million or so that they could move around, but the real growth of acres and production is in that ball is in Brazil's court right now. And on the bean side, why the U.S. number, right at 4.3 billion bushels. When you add Argentina and Brazil together, you now have a 7.25 billion bushel bean crop which is, it's what, 60-70% higher than the US. So we will always be behind them in bean production. The world still needs our beans, but they need our corn a lot more. And the point I want to make to highlight just where we are in the world production against South America is right now, and heading into this break, the rain that started in Argentina. Whenever a U.S. farmer gets an opportunity because of a weather rally on South American crops, whether it's corn, wheat, cotton, beans, whatever the case may be, it's a wonderful opportunity to advance sales, because the nice thing about South America's weather is we know that it is not going to affect one bushel produced on your farm in the U.S. It's a great time to take advantage of weather rallies or whatever may be happening down there. They have labor union port strikes and stevedore strikes all the time. So it gives you an opportunity without having to be concerned that your yield may be hurt because of a dry hot pattern in Iowa and Illinois gets larger and starts to affect other states. So keep that in mind, that marketing beans and corn during the winter is a very productive and a very safe time to do it, simply because you have no yield at risk at consequence because of their weather. What the USDA did tell us that made the markets rally out of the report was that the U.S. and world ending stocks were a little bit smaller than expected, smaller enough to get a rally out of it and take prices, corn in particular, old crop corn, up to about 3-month highs, very close to it, and beans back a good solid rally out of it. But they also said that they're not tight enough that we have the type of setup that we had in 21 and 22, where U.S. production was absolutely critical to everything that was going to happen to be able to sustain prices. So we've got, I wouldn't call it an equilibrium, but we certainly have, it's tight enough to be concerned about, but there's enough of it that we can't get overly bullish simply because stocks are a little bit tight. I'll skip over the brick and go back to that. The biggest thing, that the number one factor that we are looking at moving forward into 23, and why I say this is a transitional year and you're going to have to be flexible with your marketing plan, is you are finally starting to see this La Nina pattern, which historically means more inconsistent growing weather in both hemispheres, that is beginning to transition to the neutral El Nino. And the El Nino pattern historically, not always, but historically, has been more conducive to higher world yields, more consistent rainfall, more consistent temperatures, and what you're used to seeing when you think about normal spring and summer weather. So, and one of the things that we have to keep in the back of our mind is the last 3 years crops, 20, 21, and 22, all benefited from extremely long growing seasons that we went deep into September, whether people call it Indian summer or just the natural pattern of La Nina, to where we got an extended growing season that really added bushels that historically you kind of figure everything's done by Labor Day, that the past couple of years have seen extended growing seasons into the late summer and early fall, that we may be one of the things that we sacrifice for the rain in the summer. So I guess everybody be happy to do it, but that typically is the trend. And if we get into a neutral El Nino, I'll point back up to what our yields were at the top this year at 172.3 and 50.2, that when the USDA Economic Forum comes out with their numbers in February, trendline yields this year are going to be 178.5 and maybe 52.5, or 50 and a quarter, or 52 and a quarter for beans. So what we know, especially looking at the corn number, is we are one good weather season, growing season away in both of the entirety of the Corn Belt from 180 plus bushel national yield. And we know it's coming. It's a matter of when, not if. And with all of the improved genetics, all we need is Mother Nature to cooperate, and we'll set a new national record. And I expect that will happen within the next couple of years. The problem with national records, they're great, and they show that every farmer is doing a wonderful job getting this yield. But farming historically, unfortunately, is a very cannibalistic business. Excuse me. You go into the year hoping for the very best yields you've ever seen. You participate in competitions, whether it's a local with your retailer, whether it's a county, whether it's a statewide yield contest, and winning those things is great. Everybody loves competition and everybody loves to be good at what they do. But the problem with agriculture is the goal of agriculture is to produce as much as possible, but the goal of farming is to make money. And sometimes producing the very absolute most that you can ends up having very detrimental effects to the markets. So for everybody who wants high yield and high prices, we always get one of those years, once every decade. And 22 certainly was one of those years to where the Eastern Corn Belt had exceptional yield and high prices, but the Western Corn Belt didn't. So very rarely do we see a whole Corn Belt where we have record yields and very profitable prices. So, it's always situation when you're talking about yield and higher yield, you have to be careful what you wish for, because as soon as you produce more of something that there is not enough demand to fill, the prices will fall to a level where there is demand. And that's kind of in the situation where we believe these markets are transitioning, because if South American production comes in as expected, and that would be a record bean crop in Brazil to top it off, we will be looking at plenty of beans, China being able to buy cheaper Brazilian beans over the course of the spring and summer, rather than the available supplies that we have. So it's going to be a balance and something we're really going to have to pay attention to. And that's why I wouldn't say that I am, overly bearish. And because I'm cautiously optimistic about several things I'm going to talk about, but looking at this transition year, the previous years we've seen higher yield, and right now we simply do not know, with the interest rate hikes, the fight against inflation, the looming apparent world recession, and what China is going to do with their economic rebound from COVID, now that they are taking steps to develop herd immunity and reopen their country and their enormous economy. That's going to be really interesting to watch, because if you have more supply but stagnant demand, prices will go down, and there's a good bit of downside, especially in beans. You could easily paint a picture where November beans, even after this 60-cent drop, if everything stays through the year and the U.S. hits a 52 bushel trend line yield this summer, you could see beans easily back in the low $12 area instead of the $13.30 to $13.50 where we are today, and certainly not the $14 where we were over the past couple of weeks. So keep that in mind. One of the things that we already talked about Federal Reserve and the interest rates, world recession, hit on the Chinese COVID policy that they did a complete about face a month ago to reopen their economy, to stop the shelter at home orders every time they had a small, statistically insignificant number of COVID cases in a 20, 30, 40 million person town, to make them all go inside and shutter the economy. And with them on celebrating Lunar New Year this week, where they are in that is they believe, the last report I said, that 80 to 85% of the entire population of 1.8 billion people has either had COVID or been exposed to it. So if they are able, with their increased vaccines and the herd immunity does kick in, China's economy could potentially bounce back much faster than everyone thinks. And if that happens, then you get into the battle between the Federal Reserve and other world banks trying to calm inflation as China comes back in and for demand in the markets, as opposed to China wanting to come back in. So we still have a couple very formidable foes that could be fighting this out if China gets back into the market. I think that China coming back in is obviously bullish, and we will see what happens with the Federal Reserve. The optimistic part of the Federal Reserve is if they meet next week and see numbers and continue to see weekly and monthly job claims and consumer price index numbers that allow them to stop raising the rates and they tap the brakes a little bit, then that also could be something that helps with demand. So there are a couple things out there that are just unpredictable. Certainly the trends are not good now, but if they reversed even, modestly, could very easily help to start chew through some of these extra bushels that I'm talking about. One thing that has been a developing problem for the last 15 years and will continue to be for decades to come is the growing alliance between Brazil, Russia, India, and China. And you can see referred to as BRIC if you see it in an ag article or if you see it in a financial article. When they say BRIC like that stands for Brazil, Russia, India, and China. And the reason why those countries are becoming more and more aligned is because China needs Brazil's production to feed their population. India needs Brazil's production to feed their growing population, because now that the population's over 8 billion people, a third of those people, 2.4, give or take 2.6 billion people live in India and China. And in the next 15 to 20 years, they expect India to take over China as the most populated country in the world. And while India's diets are certainly not as Western and as meat-based protein driven as the Western diet, and where China is going with in between their hog herds and their chickens and cattle and everything that they import from around the world, it is something that we need to pay attention to. India is involved in this alliance more by necessity than by choice, because they share a border with Russia and China, and clearly you can't be at odds with such large and powerful neighbors. So India is trying to be involved in this BRIC alliance, and India figures into this because they're the only true democracy out of those three countries, and they have true democracy, elected president, and we are on good standing from a national policy, support of their national policy, much more so than the U.S. is with China or Russia. And obviously, we know that China and Russia would just soon wipe the U.S. off the face of the earth and take over what was left. So when you're talking about a growing alliance where more than a third of the world's population, a demand base for your agricultural exports, and are all getting together, and you have very poor international relationships with them on the political side, it's something that needs to be addressed. And that can only start in Washington, because we are going to have to get in a better position with China, because China at some point could use all of these billions that they've been investing in the infrastructure in Brazil and Argentina. They could get to a point where Brazil and Argentina, not in corn, but certainly could get far enough advanced that China would need very little corn and beans from the U.S., which obviously is a huge disruption when you're talking about typically your best customer being able to go to someone else. So keep that in line. India does figure well from this standpoint that we're on good terms with them. And if India can get some consolations and improved relationships between China, Russia, and the U.S., then we can get better moving forward so that we aren't at the mercy of Brazil's agriculture expanding even further year after year after year. But time will tell, but it is something to keep in the back of your mind because you'll be hearing more about it as we move forward. Biggest thing, and this goes back to the interest rate, that I've got two really good examples. What I want everybody to think about is, are your bins your friends in 2023? And if you look at the Chicago Board of Trade prices for corn and beans, there is no carry in the market. And what that carry means is that they are not paying you, say, like the May corn contract is not a nickel higher than the March contract. That would be the carry that they usually put in the market to give you an incentive to keep bushels on farm. But right now it's inverted to where basis is so good and front month futures are higher than back month that you really, they are trying to pull every bushel off farm and get it into the pipeline because of the problems that the Western Corn Belt faced this year. So with that, think about two different things. We talked about rising interest rates. And if you're farming today and anything of size, just call it starting at 2,500 acres, it's almost impossible to run that farm the way you need to run it without $1 million line of credit. And that line of credit interest rate, for simple figuring, last year the interest rate was roughly 3%, and this year the interest rate's 6%. That 3% on that $1 million is another $30,000 of interest that's coming right out of your pocket to pay back the interest. And you're not going to be able to hire, extra help, buy new equipment or lease or buy new ground, because that's $30,000 you're not going to be able to touch. It's going to come right off the top. So the example I want to use is, if you have a bin, a 50,000 bushel bin that has, corn in it, and you could get $7 a bushel for that corn. And we've been able to get that, depending on where you are. Some people are above, some people below, but we'll call it $7 for easy figuring. You could call the elevator and they would write you a $350,000 check. So that's great. Thank you very much. I appreciate it. Let's say you go to the bank and you have exactly a $350,000 loan at 6%. 6% on $350,000 in interest is $21,000. We know that that interest cost is not going away. It's a fixed cost to you. And if you were to take that $350,000 and pay off that note, you would save yourself $21,000 over the next year, as opposed to that corn just sitting there. And to mine this down even a little bit further, that $21,000 on 50,000 bushels of grain is 40 cents. If you're sitting there with bins full of grain, you are saying to the market, I need a 40-cent rally just to break even if you owe money. And when you look at it that way, that's where, and there are past couple of years, it's paid handsomely to have storage and to keep bushels on farm. This year, right now, it just doesn't pencil out. The interest expense. And the other side of it is opportunity cost, because I got several emails today that I could get savings rates and even short-term CDs at 4%. Let's say you're fortunate enough to operate an all-cash operation. You have no debt, and if you do, congratulations on that for great stewardship of your business through the years. But that $350,000 of corn sitting in the bin, you could easily take that $350,000, put it in a CD or in a savings account, and that 4% on $350,000 would be $14,000. That $14,000 on 50,000 bushels is about 28, it's exactly 28 cents a bushel. So one way or the other, if you are holding bushels on farm, and the example we're using is corn, and the same math and the same ratios apply to beans or wheat, whatever you may have, you are telling the market or taking the chance that I have to have at least a 28-cent rally and possibly a 40-cent rally just to break even for the luxury of holding this grain. So keep that in mind, because it's just one of those years that your bins are going to be there for the convenience of at harvest to keep you in the field and keep you moving, but they are not a long-term investment of holding grain this year, because with rising interest rates, that puts bin storage space at a very expensive premium, even if it is on your own farm. So keep that in mind, that that's a lot to expect out of a market that certainly is struggling to develop any bullish trend at all. And if anything, right now is in more of a neutral to bearish trend. Let's see, diesel has been all over the board lately. It has rallied from this 290 price that I mentioned in the example. The 290 price pretty tightly correlated with $70 to $72 a barrel crude oil. And that $70 to $72 barrel crude is important because either the conversation or the memo got out that the Department of Energy and this current administration is going to buy back and refill the Strategic Petroleum Reserve in that $70 to $72 range when crude gets down there. When that got out, it immediately set a floor in the price, and we've not traded below $70 in quite a while since that was found out in the market. And where we sit now, because China said that when they do get reopened, they're intending to import more crude and more diesel in 23 and 24 than they did at pre-COVID levels. So this is not, this is an absolute apples to apples comparison, that you're talking about strong demand before COVID, and they want even more of it once they get the herd immunity and the economy reopened. So if you get a break, and what I'm talking about is on the March futures, it'd be whatever the front futures month is that's not in delivery. Go in and talk to your supplier, top off your tanks, because we know that OPEC would prefer the price to be $95 to $100 a barrel. And if for whatever reason we do not have a world recession, China comes out of their recession and COVID quicker, and the rate hikes stop, there will be a very optimistic outlook start to develop, and where we're trading $82, $83 a barrel and $3.30 to $3.40 a gallon on diesel. We know how quickly diesel can get to $4 on futures, and how quickly it can get well over $5 at the pump. So keep that in mind. There are some opportunities. Natural gas is another energy one, because of the I'd say warm, but you can't call any winter warm. Unseasonably not as cold as expected in Europe and the US to this point, other than the Christmas cold snap. Natural gas prices plummeted because of use. It was almost at 7 and now it's at 3, so it's gone down over 50%. And for those of you that dry your corn, whatever you do with your propane and natural gas, you do have some opportunities, because the price down here is really low. I'm not as optimistic that it's going to rally sharply out of here. but it is something that from a historical perspective, if you use a lot of natural gas to dry your corn and your bushels, your beans, that it might be a good time to look at hedging some of that because the price has certainly fallen off the board. As I sit here, I'm going to take the better safe than sorry cautious approach. And my general outlook is that I am I'm more bearish beans, but slightly bearish corn. Going back to if we transition into neutral El Nino and we move into more production and have more world supply, prices are going to go down. Basic economic theory. Whereas with wheat, I'm more neutral bullish because I still believe that but when this war keeps grinding on in Ukraine, you look at what happened. The U.S. and Germany are sending more tanks to the Ukraine for their defense. Excuse me. That at some point, Putin is going to do something to disrupt what's now going on, a very smooth flow out of the Black Sea port, the humanitarian export corridor. And if he backs out of that and shuts that down and takes the offensive to several of those ports, then you have something that it's hard to believe. A year, we're 11 months from the invasion. We saw wheat go from $7 to $15, and now we're back, under $7. And wheat is now 60 to 70 cents cheaper while the war is still going on than it was when the war started. So some of it's hard to figure, but predicting the unpredictable is always one of the fun things when you're talking about a marketing plan. And certainly you've got to think that there is going to be a disruption, that Russia's going to get tired of pouring around with letting Ukraine export their wheat to bring in money to finance a war against Russia, and Russia could control the whole thing. So it's sometimes it's a horrible thing that's happening, but you have to look at it on how it can affect price. And if wheat were to get a quick dollar bounce out of that, something like that, then you would certainly see corn be pulled with it. And what we believe we're going to see is continued like that. That goes back to the volatility, but you're going to have spike rallies that only give you a very brief amount of time to price bushels, unlike the long extended rallies that we had in 21 and 22, where you just kind of got on board and kept selling a little all the way up and felt comfortable doing it. You're going to have to be prepared. You're going to have to move quickly. You're going to have sale orders above the market in with your buyers, whether it's an elevator, a feedlot, a processor, whoever that is, because everything happens in Russia happens while we're asleep. And unless your elevator has a 24-hour call and you're going to watch the markets for that one spike in wheat that drags corn up 25 or 30, you're probably going to miss the opportunity. And I'll give you the example right before Christmas. When one of the defense missiles landed in Poland, wheat went from 15 lower to lock limit up, basically a 55-cent move in the course of about 15 or 20 minutes. But then when they found out that it was a Russian-Ukrainian defense rocket and not a Russian rocket in Poland, in a NATO country, wheat immediately gave back every bit of it by the end of the next day. So you're going to have to be able to learn how to market the spikes, because that's what we're going to see in 2023. We're not going to see, oh, I'll wait a couple days, see if it gets better, because if you look back at price charts on these rallies over the, since May, June, since we topped out, the rallies have been harder to find and quicker to disappear. So that's my advice. Have sales targets above the market with your buyers so that you don't have to get really lucky and be at the right place at the right time with a phone in your hand to call your buyers. Jeff, that's about it. We'll do the last photo with the last slide. In the newsletter that I publish, this is what I put on the second page. The newsletter I publish goes out to over 7,000 recipients in 33 states and a couple different countries last time we checked. And what we try to do is I will read 35 to 40 pages of information every day from all sorts of sources across the world. Excuse me, some of the sources you're familiar with, some of them you've never heard of. But what I try to do is get a really good idea and a broad picture, boil that down into the newsletter into a 5 to 7 minute read to give you an actionable plan. It's an education tool. We're in the education business. We are not in the prognostication business or trying to, pick absolutes on what the market's going to do. But if we educate everybody and educate ourselves about the general trends, we certainly can do better. And I'll always have standing sales targets. Always happy to put out my track record, because what I know in the marketing game, I can look back and go, gosh, that year wasn't very good, or that was kind of a dumb move. Or I can look back and go, wow, that was really, really smart to sell, that, even though it didn't seem like it at the time. Because I know that everybody that markets, every farmer that has ever marketed his own grain goes through those same emotions. And we're very happy with our track record. I'll put it up against anybody's. And what I try to do is have, like you can see on the 22 crop, we sold a little bit more today because, like I said, I'm in the better safe than sorry trend rather than the hopeful of a rally, and try to always look out and have the window of a couple of 3 years, because farming is a long-term business where you've got 23 crop to plant, probably still have a little 22 crop to sell. And even looking out when we make this transition in a couple months to bring ideas about where 2024 prices are, there'll always be something in there to give you a little guidance about what we're thinking. And what I'm worried about with old crop corn and why I'm close to being finished is that basis is going to start to fade. Basis has been so strong that you got some of the best prices of the entire marketing year well after harvest, better prices than you could have gotten in May and June when the futures price was actually higher, simply because of the demand and shortage in a lot of areas. So, but I have no problem trying to find a spot for a spike to be out of all of my old crop. Simply back to the example I used, that money can be better used to pay off debt, to stop that interest, or to invest it in a short-term CD rate and take it out of harm's way from if these markets continue to go lower on improved weather in South America. And then on 23, got started at 608. We lowered that, and we did sell a little bit today. I'm sorry we had to put this slide deck together, and I've changed it since then. But if you sold some December corn above futures at 590 or any rally up towards 6, I think you're really starting off the year in a good spot. I would have loved to have started at 625, but the drought in Argentina kind of scared me away from that, unfortunately. So that's our outlook. That's what we do. And I'm happy to be associated with Old National Bank and to be able to be here today. And Jeff, have you seen any questions pop up that we could answer?
Yes. No, thank you, Jody. Thanks for that outlook. And one question kind of came in, and it's also kind of top of mind with what you're speaking about here, is, in general, two things. One, short-term old crop prices. We've got a gentleman, so he's looking to know if we can see soybeans back up above 1502 on the front side of the curve. He says he stores them and is thinking about marketing them more in May or into June. But I think the equation is straight there for you. You've said you've got interest rate costs that are out there that could I just did quick back of the napkin. 10 maybe 15 cents in interest cost if you're borrowing money between now and June, plus storage costs, plus the fact that we're already paying high basis in most areas, particularly he's mentioned he's in North Dakota. So, there seems to be more risk in holding on than the going ahead and contracting, but welcome your feedback, additional feedback.
Yeah, that question is directly why I made the point about are the bins your friends, because I think we're just going into a period, especially in the prepay, when you can take advantage of some discounts and do some other things, and writing checks with it, that you can definitely, you're better off with cash in the bank. And paying off whatever loans that you have, because even if you just put it in a 2-3% interest, just like you said, instead of begging the market to prove you right and rally so that you can sell it just to break even, it doesn't make any sense to ever adopt that as a marketing plan, because hoping the market bails you out it leads to more heartache than it does to good times.
Can I just add in something really quickly that if you're an Old National customer, please talk to your Old National banker. We do have some money market and some CD rates that I think would be attractive to you if you end up with that additional cash.
Yeah, and that's it, because you have to really right now you have to search for those online rates, and then you go through the process of opening new bank accounts. It's much easier just to go to the bank and potentially, like I said, I was hosting a podcast a couple weeks ago, and I said, "What CD? What is that?" And, I have an old stack of them in my garage, but the reality is it's probably a good opportunity.
Yeah, definitely a good opportunity right now.
So okay, that's one. And since we're talking with you, Rebecca, there was a question related to interest rate costs and the function of, is there a way to hedge interest rates? Maybe we've already gone through most of the cycle, but there still seems to be some upside. What are your thoughts on hedging, and how do we engage that?
So let me break this into two sections. If you really want to go out there into the marketplace and hedge your interest rates, you're going to need to talk to a broker. That's something you can do through a bank. But if you have floating rate debt and you want to hedge that by purchasing an interest rate swap and converting that to a fixed rate that's an all-in rate for you, we can definitely talk to you about that. And happy to introduce you to our capital markets team. Our lenders have familiarity with this, but they are the experts. So we would, stay there with you every step of the way to make sure you understood what your options were. So if it's a bank or a loan related product, please speak to one of our relationship managers. But if you're looking at hedging in the marketplace, that is going to be, I'm going to leave that in Jeff's hands.
Yeah, and I think just to comment related to the hedging on interest rates or fuel costs, which is another question that came in, is the first question is, how much are you trying to hedge? Are you dealing with a $250,000 note or amount of interest that needs to be financed, or 10 million? And with most strategies, the same thing with fuel. Are you talking about 10,000 gallons or 100,000 gallons that need to be hedged? And I think Jody would agree with me that, our philosophy is really never to go all in. You're really, everything is incremental. You saw Jody's recommendations on on the grain marketing. Slow and steady wins the race. Take advantage of opportunities, have a plan, trade your plan. And the same thing would apply to interest rates in energy. If you have a massive amount of debt that's coming due and want to protect that, we can help. If you're using significant amount of energy over the summer versus your neighbor who's smaller, and your fuel broker in town is trying to sell you on just waiting it out, listen, you're in charge of your business, and we can put some hedges in place to help you protect some of that risk. But Jody, did you have any more comments on that?
No, that's it. Just wait. The same thing with buying what you need. You just inverse the way you hedge grain. You love to sell rallies when you're selling your corn and beans, and you love to buy dips when you're hedging your fuel. You just have to think one big picture, that there's always an opportunity. When prices were low during COVID, everybody kicked themselves for not buying, $15 crude oil. And because we've already, gotten over $100 since then, and you could have been hedged for, the next 10 years of use on farm with a couple things like that. And so much stuff happened during COVID. Certainly hope we don't get another pandemic, but it seems like we're getting more and more of what we would call, oh, that's a once in a lifetime event. That's a black swan. And they come so often anymore that we're getting great pricing opportunities on the sales side, and also some good purchase hedge opportunities on the low end when things do break that way. And 2023 may be a year where we get both, because we're, as the world economy settles out and whatever may happen.
Yep. No, it's very fair assessment. But overall, I think recap from today is that a lot of market risk out there. Last question that actually I came up with was, make sure I'm doing the math right here, Jody. We're saying soybean break evens are around 800. Break evens around 800. And if you're telling us yields might be 52, that means we need 1538 priced soybeans to break even.
Yeah, that's where that 800 may be a little high, and everybody should know now, or be real close to what it is. But certainly where the price of beans is now that we've broken, substantially this week. Even if you got a flat 1350 for it and your yield was 60, you're still only at $810 on what may be a full fertility program for that acre of beans. So the margins on beans certainly have shrunk this week to a point they're not as attractive as corn. And with corn, you can get 590. Let's take normal basis off 550, 200. There's your 1100. And if it's costing you 1,000, you're making money, but it's certainly not the $300-400 an acre that we made in 21 and 22.
Perfect. Yeah, thank you for that, because I just need to check myself for a second. But nope, this has been super helpful and great. Rebecca, did you have any last thoughts or questions for Jody or the group?
Well, we just really appreciate the partnership with RCM and Jody's expert guidance that he provides to us. In terms of questions, not really for today, but please feel, I know you just put my phone numbers in the chat. I don't know if, yep, there you go. Thank you. You got my numbers there. So please reach out to me if you have any specific questions on the banking side. I can connect you with a relationship manager, or I might be able to answer your questions directly. Keep in mind, to make sure that you're looking out for opportunities to learn more about marketing, such as this webinar. And please reach out to Jeff or Jody if you'd like to work with them or talk to them in the future.
Absolutely. No, thanks, Rebecca, for setting this up and including your group. It's been great working with you and the team. And obviously we had some nice live events in the last few weeks, so that's been fun. So look forward to continuing those. And Jody, we've got to wish you well wishes here in the snow and the treacherous winter that you have. How many more meetings do you have this year?
Oh gosh, we're booked all the way out till the end of March. And my biggest concern, because they start to get a little bit warmer, I will be at Commodity Classic. But my biggest customer is Helena Agri Business, and I'll be hanging around their booth at Commodity Classic. So that's in Orlando. I get to go to Phoenix for another customer event. But next week we'll be all over central and northern Illinois and southern Wisconsin, and we're looking at a bunch of single-digit nighttime lows. And you don't live in Nashville for single-digit nighttime lows. So if I can get by the end of next week without frostbite, I should be okay.
That's
great. You'll be all right. If you need some help on how to dress, just let us know.
Layers.
Yes.
If anybody would like to reach out to find out where Jody's going to be, if you can get out and see him, just send us a message or send me a message, and I can get you his schedule. But other than that, appreciate everybody taking the time. We look forward to doing this again with Old National here and Jody, and keep people updated with what's going on. So again, I'm Jeff Eisenberg. We had Jody Lawrence and Rebecca King. Thanks again to everyone. Have a great rest of your day.
Thanks so much. Take care.
Thank you.
You've been listening to The Hedged Edge. Links from this episode will be in the episode description of this channel. Follow us on Twitter at ag_RCM, like our Facebook page under RCM Ag Services, and visit our website to read our blog and subscribe to our newsletter at rcmagservices.com. If you like our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear them. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.